Thank you for joining us today on Fidelity Connects. I'm Colin Randall, Director of Research at Fidelity Investments Canada. It could be said that digital asset markets have been on a roller coaster in 2025. Bitcoin kicked off the year strong, helped by significant spot ETF inflows and continued institutional money, pushing the asset to a new all-time high of 175,000 Canadian dollars in early October. Ethereum followed on a similar pattern, reaching roughly $5,600 at its October peak. But since then, prices have reversed, and Bitcoin has slid from its high to around $120,000 just recently. But of course, digital assets have not been just about volatility this year. A major development happened on the regulatory front, the Genius Act in the US and the Stablecoin Act here in Canada, first of its kind in this country, among other countries around the world who are currently on a similar path. Joining us today to talk about these developments and more is Chris Kuiper, Vice President Research at Fidelity Digital Assets. And just as a reminder, today's show has a live French audio interpretation. Chris, thanks very much for joining us.
Yeah, thank you for having me. Great to be here.
Well, I think we have to start with the markets. We were just chatting before we came on. It seems that the market slide that we've been seeing over the last several weeks, at least currently, is on a significant upswing. Maybe we could start with the price of Bitcoin. What's been driving Bitcoin year to date, and particularly in the last several weeks?
Yeah, we'll start at the bigger picture, some of the things you mentioned. So zooming out to the full year here, it certainly has not shaped up to be the year that most people were expecting. I'll even include myself in that category. And that's because with Bitcoin and crypto in general, you've had traditionally these 4-year cycles, and we were in the third year of the cycle, the bull market year. This is typically when the biggest gains are made. And it looked like things were shaping up to be like that. As you said, new all-time highs were made, largely driven by the exchange traded products, as you mentioned, and then the rise of these digital asset treasury companies, or DATs, as they're being called. These are companies that are buying digital assets and putting them on their balance sheet. So that drove the market higher throughout the year. We hit those new all-time highs. Things were looking good. And then we really just chopped and consolidated over the $100,000 US dollar mark for us here. And we saw a consistent selling from a major cohort, which were long-term holders. Now, because this information is on the blockchain, it's verifiable and observable, we could see people who had held coins for 5, 7 years or even more were constantly selling them into the bull market rally. Now, that's not a bad thing. We see this all the time with each cycle. You get a rotation of the investor base. People who held a long time, who had very early conviction, they finally wanted to sell a portion of their Bitcoin holdings. They wanted to realize some of those gains. People have to live. They've got dreams. They've got aspirations. And we've seen this anecdotally. We saw from a very large trading firm that's publicly traded, they made a press announcement that they helped liquidate $8 to $9 billion of someone's Bitcoin holdings for estate planning purposes. Now, to me, I looked at that and I said, the fact that they liquidated that much and the price hasn't gone below $100,000 at the time, this was this past summer or fall, that just shows how big this market has become. So that wasn't a bad thing. But then you saw those two major demand drivers dry up. The exchange traded products have paused or slowed or even reversed here. And we've seen the digital asset treasury companies pause or slow down their buying as well. And so that's why we've seen a lot of weakness in the price action. And then to get to your question, to end on the more recent action, you have to go back to October 10. We saw a huge liquidation event. This was on the concerns of more tariffs, especially on China. And you saw $10 to $20 billion being liquidated. That was more than the fallout from FTX, if you remember that fiasco. So the fact that we had that big of a liquidation and it didn't make near as big of a dent in the market, again, shows how far we've come, how big this market, how deep and liquid it is. But it's been a negative overhang ever since. And then yesterday, you had maybe some unwinding of the Japanese yen carry trade with Japanese yields really spiking here. Some more macro uncertainties. You saw Bitcoin sell off, a lot of liquidations there. And then today, we're ripping back higher as a lot of, I think, these liquidations got reset. So a lot of stuff going on here. The other thing I'll point to, though, is the record run in precious metals we've seen, both gold and now a new all-time high in silver. Bitcoin, as you may know, has the same characteristics as gold and even improves upon some of them. So they're driven by a lot of the same fundamental factors, but they don't move together. They often take turns and trade off around every 90 days or so. So that's something we'll be watching in the next few months and going into 2026.
It's great context. And, with even with the selling pressure that we've seen over the last couple of weeks, this crypto market still has market capitalization well north of 3 trillion USD, north of 4 trillion in Canadian dollars. And so even with this downward pressure, we can see a still enormous market and certainly growth in digital assets. You mentioned DATs, or digital asset treasuries, and I think we're seeing some headlines this morning about DATs. Could you, just for the audience, what are DATs? Explain what are DATs and what has been driving their price movement?
Right. I think there's two buckets to distinguish here. There's companies that may purchase Bitcoin as just part of their cash management strategy. They want to diversify some of their cash out of maybe low yielding treasuries or short-term debt. And they want to preserve their purchasing power for the long term as a company, as a going concern. And we've seen a few companies, even publicly traded ones, that put around 5% or so of their cash into Bitcoin. So that's one bucket. What you saw dominate this last year, and certainly in the news today, is a different type of company where they're using their position as a corporation, and especially as a publicly traded company with access to the credit markets, to issue debt and use that debt to buy Bitcoin. So think of it more as like an arbitrage. And it's especially prevalent in other countries where they have different geographic restrictions or different tax laws, where people either can't get spot exposure to Bitcoin, or it's maybe not very tax advantageous to do so. So they're getting the exposure through these companies instead. Again, that's just what they are. The issue for investors, and the bottom line, I think, to really know and understand about these is they hold a certain amount of Bitcoin or other digital assets on their balance sheet, but their shares, the value of their shares and market cap may trade above that. So if you're trying to get exposure to these assets, you might be paying, in effect, a premium to that underlying exposure. And if you buy at a premium, there's the chance that the premium can shrink and you can actually be behind. So again, depending on where you purchase these, the stock can go down more than the price of Bitcoin, or vice versa. The stock can go up more than the price of Bitcoin or whatever digital asset they hold. So that's the thing for investors to realize with these vehicles. You're getting exposure, but you're getting it either in a leveraged way or you're buying them at a premium or a discount. Right.
Versus, say, investing in an ETF or a mutual fund, which is striking a NAV every day and avoiding that premium or discount. Great, that's a great point.
Yep.
Could I ask about Ethereum? So that's sort of the big number two in the digital asset space. It tends to follow Bitcoin. Is it being driven by the same types of pressures that Bitcoin is?
Overall, it does move. The correlation is still very high between Ethereum and Bitcoin. It does get lumped in with the crypto basket. And given that it's usually around about a fifth of the size of Bitcoin in terms of market cap, it tends to be more volatile. However, we are seeing Ethereum have its own cycles, and it's being driven by its own fundamentals, whether that's upgrades coming down the pipe or activity on the blockchain, or we saw with this crop of digital asset treasury companies this past year, a couple of them went and bought loads of Ethereum rather than Bitcoin. So that pushed the correlation apart from Bitcoin for Ethereum as well. So overall, long-term, still very correlated and even more more volatile, but starting to decouple, and it might have its own cycles as well.
That's great. So maybe staying on smart contracts, blockchains, and of course Ethereum is a different architecture than Bitcoin, in that it offers smart contracts and sort of programmable money. Solana is something that your team has been following for quite some time, and just recently published a report on the Solana ecosystem. Could you share, first of all, what is Solana? How is it distinct from Ethereum or Bitcoin? And what are you looking at in that crypto space? What do you find appealing, and what should investors be thinking about as it relates to Solana?
Yeah, great question. So number one, we do think you have to separate Bitcoin from everything else. Bitcoin, we believe, is best understood as a monetary good, so a potential store of value. And you can think of it like a digital commodity. It has a hard supply cap, and people are treating it as a money. And so that has its own investment thesis. Then there's everything else. And that's not to say everything else is worse or better. You just have to have a different investment thesis and lens. And these things are, as you said, they're smart contract platforms. So they're more programmable. You can build stuff on top of them, build applications on top of them. So they're trying to solve a different problem. And there's a different product market fit there, but there's also a lot more competition. Whereas I, for example, don't see anything competing with Bitcoin in the near term. There's way more competition between all these other things. So you mentioned Ethereum and Solana. What is Ethereum? You could consider it a successor to Ethereum. So Solana is a successor to Ethereum, and therefore it's much more of a competitor because they're both smart contract platforms. And what this means is they're like a distributed computer. You can build decentralized applications on top of them. Now, somewhat different than Ethereum, Solana prioritizes and focuses on speed and low costs, and along with that, high bandwidth, low latency, or fast response time. So it's trying to be a lot faster and cheaper. Now, not surprisingly then, the applications that are being built on Solana are things where you want speed and low latency. So trading is the number one application on Solana today. And this is why Solana's own stated goal, a very audacious goal, is to bring the entire financial system, the existing traditional financial system, onto its platform, onto its blockchain. Now that comes with some trade-offs, right? You can't do something better than Ethereum without some engineering trade-offs, and this is something we talk about a lot. And so investors need to be aware of this. Number one, Solana's infrastructure is more expensive to run. You need beefier computers and components to run this network. That means fewer people are going to run these validators or these computers running the network. It's more expensive, so it's less accessible. That means Solana, compared to Ethereum, is less decentralized. And you have to decide if that is something that matters to you. Do you want control to be in the hands of fewer people, or do you want control to be dispersed among more people around the world? So this is why we see, even though Solana has a lot of activity, it has a lot of transactions, most of the value is still on Ethereum. And so I think that's for a number of reasons. Number one, Ethereum was first. It's been around longer. People trust it more, and it's more decentralized. And when people are valuing that for higher dollar amounts being locked up in that network. But we'll see. This is a big question for investors going forward. What does the market want? What is the value? Where's the market share going to go between these two?
So you mentioned that if Solana's grand dreams or our plans are to, effectively form the basis of the financial system going forward, how would Ethereum approach that I guess area? Is it focusing on different types of projects?
It's also wanting to do that. Still, a large bulk of the decentralized finance applications are still on Ethereum. So number one, most of the stable coins are still on Ethereum. Most of the value locked up on stable coins is on Ethereum. Most of the DeFi stuff is on Ethereum. So think of like lending and borrowing on the network. That's mostly on Ethereum. And we see this with Ethereum has regular upgrades too, where we have another one coming up in just a couple days here. It's going to be live. We see Ethereum focusing on these things as well. And again, this gets down to the big questions. They need to choose like where they want to compete with Solana and where they don't. And for our investors, the questions will be, is this going to be a winner take all or winner take most scenario? Or is there room in the market for two different networks serving different purposes, different consumers, different applications?
Yeah, that's great. I tend to think of these in terms of the blockchain trilemma, right? Where there's this balancing act between security, scalability, and decentralization, just as you said, Chris, where Ethereum can potentially offer greater security and decentralization. That may come at the expense of scalability, whereas it seems, from what you're saying, Solana is really focusing on that scalability and might need to give up on the decentralization and security as a result. Is that a fair assessment?
Yeah, that's a great way to think about it. And I think investors need to be aware of that. There's no free lunch. These things come at a trade-off. The other trade-off that we've seen with Solana, and it's less so of an issue today, is we did see the network go down a number of times. That hasn't happened in a long time. But again, if you have fewer people running it, it's more technically complicated to get these really, really fast things synchronized and done. There is some extra risk with Solana on the technical side of things as well.
Great, great.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of Fidelity Connect's podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connect's, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
Okay, shifting gears now, I want to talk about stablecoins. 2025 has been an interesting year of announcements related to stablecoins from governments in the US, and of course, just recently here in Canada, the recent federal budget, the Canadian government unveiled a new framework that would regulate stablecoins. And this, of course, follows the passing of the Genius Act in the US back in July. Maybe we can start with the basics. What is a stablecoin and what is it used for?
Right. So the simple definition of a stablecoin is it's a cryptocurrency. So it's like all these other tokens that sit on a blockchain. It runs on these crypto rails and networks, but it's stable. Its design is to not fluctuate in value against a currency like the US dollar or the Canadian dollar. So it's pegged to another currency or sometimes a commodity like there's gold and stuff like that. And therefore, it's backed by this other currency. It has a reserve behind it. Now, that's different than Bitcoin. There's nothing, redeeming that you can redeem for Bitcoin. You can't bring your Bitcoin in and redeem it for something else. It's just Bitcoin. It's like a commodity, like something is just gold, or even today, it's just $1. So the idea of the stablecoin is that it's pegged. It doesn't fluctuate. And then what is it used for? The three main things, really. And stablecoins have been on an absolute run in terms of their creation. We've gotten hundreds of billions of dollars worth of stablecoins nowadays because they found this perfect product market fit. And the three main uses we see it being used for is number one, trading pairs and DeFi. So if you're on an exchange, you want to trade out of your position in Bitcoin or Ethereum, you want to go to something stable and get volatility off your books. You can go to the US dollar, but then your exchange is going to be set up to accept and take US dollars or Canadian dollars with the whole banking system. Whereas it's a lot easier to just trade into a stable coin. These are the most highest traded pairs out there. And then all of DeFi uses stable coins. So if you're borrowing or lending on chain, that all uses stable coins. And then the other two is just moving money. So moving money across borders is a big one. Remittances, much cheaper to move stable coins anywhere in the world rather than use a wire, ACH, a company like Western Union, something like that. Those have average fees around the world of 7%. And then just payments. You can use stable coins to pay for things because it is a stable currency, just like using the Canadian dollar or the US dollar.
Right. And there are centralized stablecoins, which are what are being announced by the governments. There are also decentralized stablecoins, picking up on that conversation we were having about Solana. What's the difference between the two?
Right. So what I think you're getting at is whether or not there's a central issuer behind the coin. And most stablecoins today, and by far the most popular ones today, are all centralized, if you will, meaning they are issued by a company or an organization. So this company will take in dollars. People will send or wire in something like US dollars, and then they will mint or create the stablecoin on the blockchain. And then they're responsible for holding that asset or investing those dollars to back the stablecoin. And then they can also do the reverse. You can send your stablecoins in and say, I'd like to redeem this. And then they'll give you back the dollars and burn it. Now that's done at a very high level with like big players and institutions. But that's the point of a centralized issuer. Not as popular yet are these decentralized solutions where they do everything on the blockchain. So there's no central company, party, issuer. It's all done with software on the blockchain with these smart contracts where you send in some kind of collateral like Bitcoin or Ethereum, and they'll issue you a stable coin. Now, because of this, they're often over collateralized. So you have to send in more of something like a Bitcoin because you can't send in dollars usually. So they're not as popular, but mostly what we're talking about is centralized issuers. Now, that's different than what you noted about the governments, though. Whether or not the government is involved is a separate issue or question.
Mm-hmm. Well, that's great. Well, it's a very interesting space that we'll want to keep an eye on, but certainly nice to see, good to see governments playing a more active role in the regulation of digital assets and further, I think, further adopting these as legitimate financial assets. Maybe we could shift gears and talk about quantum computing. That's been another theme in crypto circles that folks are paying more attention to. I think there have been some interesting developments in terms of quantum computers in recent months. What are your thoughts there? Does this pose a risk to digital assets?
Yeah, it's one of the number one questions we've been getting as these developments and seeming advances are being made with quantum computers. Does it pose a risk? I would say yes. I don't think there's a lot of debate over the fact that if a quantum computer were developed or developed to enough of a level of power, it would be able to crack some of the encryption that is used in Bitcoin. Now, to be clear, though, if a quantum computer gets to this level, it's going to be able to crack encryption on all kinds of things, banks, governments, three-letter intelligence agencies, you name it. And so this is why this issue of quantum computing has been being worked on for decades. Computer scientists and government agencies all over the world recognize this as a potential scenario and threat. And so they've been working on it for decades. The question is, when it will happen, and there's a lot of debate. We talk to people in the industry all the time on this, and we've gotten anywhere from this could happen in a year or two to this is at least 20 to 30 years out yet. So there is not consensus as to where this is. But as you know, technology can move. It doesn't move in a linear line. So we may wake up tomorrow and someone announces that they've done it. They finally created a quantum computer capable of cracking encryption. So it's not just a problem for Bitcoin. The other thing to note is that we have a solution. It's not like if this happens, where we don't have anything at all. There's actually quite a number of solutions available. And I've been to technical conferences where people have presented these, and the people who work on the Bitcoin software are debating this. It's a matter of which one do we want to use and adopt, because again, they come with trade-offs. They come with different trade-offs in terms of how much resources they'll take up and size and availability and all of that. So we have solutions. I think the bigger risk is because Bitcoin is completely decentralized, it's not controlled by any one person, corporation, or government. You have to get consensus of the entire community. It's governance by consensus. And so the bigger risk is if something happened with quantum overnight, that would not give the Bitcoin community a lot of time to respond. It takes time to build these consensus changes. If the code needs to be updated or changed, we ideally want more time to do that. So it's something that's being worked on. Mm-hmm. It is a threat. I don't think it's as big of a threat as people think it is. The other note on that is that even if someone does crack it, the whole network doesn't just stop working. The most likely thing that will happen is that there's some very old Bitcoin in old address types that could be cracked first. And so the worst thing that could happen is these coins are then stolen or gotten control of by someone with a quantum computer. And you could think of that as almost like a bounty for someone who cracks this first. They'll get access to quite a few billions of dollars of Bitcoin. But the key is, whether you think that's good or bad, the key is that doesn't break the network. The network still works. The supply cap is still in place. All the other rules stay the same. So something we're certainly watching, and it's got a lot of interesting angles here to look at.
Well, and it sounds like the developer community has been thinking about this for some time. I think it's been over 10 years that I've seen, quantum computing being discussed among engineers in the crypto space. And so this isn't new, but to your point, I guess it's just more of a question mark of when Q Day ultimately occurs.
Yeah, and for investors, the thing to be careful of is with any risk or big change that is legitimate, like quantum, there's unfortunately going to be people who take advantage of this and start to scam and defraud people, saying like, you need to move your coins to this address so it's quantum resistant, or you need to upgrade this and click on this link. So just, if any of you, deal with your coins personally, just be very careful out there is what I'll say.
That's great point. Actually, that ties into a question that we've just received from the audience, asking about Fidelity's approach to custodying Bitcoin for the funds, for example. Could you shed some light on that?
Yeah, so one of the interesting things about our history is Fidelity back in 2012 or even earlier discovered Bitcoin. They started playing around with it. There's this group at Fidelity called the Fidelity Center for Applied Technology, where they are constantly looking on the horizon for new things for either to augment their business or that could potentially upend our business. And they found Bitcoin. And what's fun about this group is they don't just read about it and write about it. They get their hands dirty. So they started mining it first. And then they realized, well, if we want to hold it, how do we do that? How do we custody this? And there was no institutional enterprise grade custody solution out there. So we built our own. And that is what we still have today. We have our own custody solution built from scratch. So it's all in-house. It is a typical cold storage type of arrangement where almost all of the coins, except for a tiny fraction or percent or two, are kept. Only a little bit is kept online for trading purposes for people who need liquidity. Everything else is kept in cold storage, offline, in these secure modules. And other than that, there's not a whole lot to say other than we can leverage our decades of cybersecurity expertise, our thousands of people, cybersecurity experts. And so that's one of the advantages we have at Fidelity is we have experience in risk management, which is what a lot of these crypto native companies don't have some of the time. And something to be aware of.
Absolutely, and much rather have an army focused on the security of someone's digital assets, my digital assets, than having to worry about my own seed phrases and hardware and so on. Absolutely see the advantage there. We're just coming up to time, Chris. We could just wrap by asking you, what are the key themes? What are the key areas of the digital assets markets that you're watching right now that you think our advisor and investor audience should be watching too?
Great question. We will have our 2026 look ahead, our annual look ahead out early next year, as we usually do. So the entire research team, all 6 of us, we all write a piece on what we see coming, what we saw over the last year, how we think that's going to play out. So I don't want to give too much away, but I think for your investor audience, I think the thing to watch is how this asset class will continue to grow and mature. We are now on the world stage. We have governments, as you mentioned in this webcast, creating legislation. We've got countries adopting it. We just had last week the Czech National Bank, the central bank, put some Bitcoin in a test account to start understanding it. So this is the first central bank, national bank that has done so. So every year we get more and more signposts or milestones here of how this is being adopted, how this is not going away. I firmly believe this will continue to reshape our entire industry. So continue to watch for those things and just keep learning, keep learning about it. Everyone starts somewhere, and start asking yourself, what don't I know yet? What do I still want to know? What are some of my reservations? And that's what we're here for as well. So you can find all of our research at fidelitydigitalassets.com.
That's great, Chris. Thanks, as always. Really appreciate you taking the time to speak with us today. Always appreciate your insights on this constantly evolving area of the markets.
My pleasure. Thank you.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.